Welcome to Taking Stock with Lisa Brown. My special guest today is my colleague, Nick Fazio, an investment analyst who researches investments, including stocks, on a daily basis. And he shares his outlook for the markets with investors. Nick recently published a popular article in the national media claiming the recession is good news for investors, which is quite contrary to what most people think about when they hear the word recession. So I've asked Nick to join us today to share more about why a recession can be beneficial to you if you're putting money into your 401k plan. Welcome, Nick.
Hi, Lisa. Thanks for having me.
Now, Nick, economists and politicians are all over the news these days talking about a recession. Is it here? Is it coming? And how bad will it be? What is your take on this?
So, Lisa, I'm going to defer to the National Bureau of Economic Research on this one. They're the nonpartisan, independent organization that determines when the U.S. economy is in a recession and when they're not. And as of right now, they're very emphatically saying no, that we are not in a recession yet. In July, we did get the second consecutive quarter of negative GDP growth, which has historically been indicated as an alternative definition of what a recession is. But really, there's just so many positives still in the economy right now that it's tough for the NBR to come to the conclusion that we have reached a peak in the economic cycle to date. So if we were in a recession at this point, in all the recessions since 1948, this would be the highest amount of jobs added of any of those recessions. It would be the highest growth in industrial production of any of those recessions. And it would definitely be the lowest employment rate of any recession because we're in the lowest employment rate basically on record, whether in good times or bad. So I'm pretty confident in saying we're not in one right now. Now, could that change in the next couple of years? Absolutely. But as far as how bad it would be, the term recession is very binary. It's a light switch. Either we're in growth or we're in contraction, where the real world is a little more nuanced. And because of some of those facts that I just listed, it seems that if we even were to go into recession in the next couple of years, most people, as far as things go on a relative basis, are decently well off at the moment. They had a decent amount of stimulus come in during COVID. It's been a very prosperous, almost past 10 to 12 years. So while recessions are never fun, it does seem like if we are going to have one, people are generally in a pretty good place.
That's really calming and reassuring for hopefully a lot of people who see the word recession on the news and they might hit the panic button or think, gosh, there's really, really dark days ahead. Now, you've done research on what typically happens in the stock market after a recession is formally announced. So tell us what the story has been with the last 6 recessions.
Yeah, some of my favorite stories, both in markets and life, is where we have this general common knowledge, if you will, that turns out to maybe not quite be what everyone thinks it is. And I think this is a really good example. So if we were to look back in the last 6 recessions, that goes back to the beginning of 1980. The stock market actually hit a bottom before, the NBER even announced to the public that we were in a recession. And since we only know when a recession starts in hindsight, that announcement's really important because it's all conjecture up into that point. And when you're in the moment, it's really difficult to know, are we in a situation like right now where we're in a period of uncertainty until you get that official announcement. So yeah, in the past 6 times, 1 year after the official recession's announcement, the stock market was down in only one of those 6 events. So in the other 5, 1 year out from the recession announcement, the stock market returned positive. When we get to 3 years afterwards, they're all positive. And when we get to 5 years out, in 3 of those 6 instances, the gains were over 100% already. So recession announcements can be, definitely scary, but the general history shows that you're probably past the worst of it by the time that announcement actually arrives.
So, Nick, do you think that this trend, 5 out of 6 recessions tends to have some positive returns in the stock market? Do you think that trend is likely to continue?
I really do. And I think it may even be a better continuance in the future than we've even seen in the past. And when we think about why that might be, the short of it is that, as we all know, markets are extremely efficient, and information gets priced into the market very quickly, which is very easy to gloss over and say. I think it helps every now and then to kind of dig a little deeper in that and think what's actually going on. So if we think about who actually moves markets, you're going to be thinking about the big mutual funds, the big pension funds, the big hedge funds. And they're the ones who are actively doing a lot of research on the market, and they're pumping trillions of dollars into their methodology of what they think is going to happen. And what you're seeing, especially as we progress, so the 80s were one thing, but with the internet and information and everything, it's at such a faster pace today. You're basically seeing an arms race of who can get the best information and enact it as quickly as possible. So these funds are managed by, they probably went to Wharton undergrad, Columbia MBA, CFA charter holder, you name it. And they have legions of resources on their team as well. And they're all over the place, trying to find any kind of edge they can to predict where individual companies are going to be and what that means for where the broader economy is going to be. So they're not waiting for the NBER to announce a recession. They're not waiting for the Bureau of Labor Statistics to announce GDP changes. They have their own models and they're collecting their own data, and they're not waiting on those official announcements to act on that. So what you eventually see is that they are able to insert this information into market prices before the official announcement even happens. Which is basically to say that if you are sitting at home and you're reading, something in the newspaper or watching something on CNBC or even the general news, the chances that you would be able to act on that information before it's already been incorporated into the market is very slim. Chances are these funds have known that information through their own estimations for weeks, and market prices are already reflecting that.
So let's bring this home to what people can do on a day-to-day basis, knowing that nobody can predict the future. There's a lot of people with a lot of resources doing a lot of research out there. But for working professionals, you're going to work every day, you're putting some money into your 401k plan from every paycheck, and that money is going from your paycheck into the investments you've chosen into your 401k plan. And for a lot of people, that is one primary systematic way that they're saving for retirement, which we think is a good thing. Having your savings automated is a good thing. So talk a little bit more about why money going automatically into your investments is a good thing for investors.
Yeah, it's a great question. And for the whole generation of workers who basically started their career after the great financial crisis, this is the first long-term opportunity they have had to put money to work in the market at prices lower than at then all-time highs, of which I'm definitely a member of that. So the systematic purchases without thinking about it, it's on repeat, it's putting the same amount in every 2 weeks. Those purchases have been able to be made at great prices this year relative to all the purchases that you've made before then. So I think it really allows you, especially when it is automated and non-repeat, and you're not having to consciously think about putting money in, it lets you take advantage of the lower valuations that are going on in the market without you fretting over what you've seen in the headlines or where you've seen asset prices be lately. So I think any kind of automation you can have, and a 401k is a great example because that's probably where it's easiest to set up. But even if you just have recurring contributions to a brokerage account or a non-retirement account, anything that allows a systematic process to take over where we don't allow our fears or our emotions to kind of take over is definitely a prudent way to approach this kind of environment.
So what is something that could go wrong with that strategy? What are people not doing correctly if they're putting money into their 401k plan today?
It's a great question. And I think while I just touted how great it is for things to be systematized or kind of on default, you need to make sure when you're setting up that 401k plan that you're not just relying on whatever default setting is there. Because chances are the default investment selection, for example, may not be prudent for where you are in your particular stage of life. So if you're in your 20s or 30s and you just joined a company, if the default option is, for example, just a money market fund, that's not going to give you the capital appreciation over time to have that money grow into something meaningful in retirement. On the other side, if the automatic investment option is your own company's stock, if you're 50 or 60, that's way too much risk tied to your employer. So you have investment risk that's not diversified. Your income stream is coming from that same risk source. So just making sure that you're well diversified and your asset allocation is prudent for your stage of life is definitely something that you need to check before you just continue to ride out your 401k.
And I know a lot of company 401k plans, Nick, have a feature called the automatic rebalance feature, where let's say you set your mix and you want, for example, 80% in the equity funds and 20% in the fixed income funds, and you can check a box to say, rebalance this quarterly or rebalance this annually. That will sometimes help people who don't really pay attention to their 401k investments to make sure that they're taking advantage of the highs and the lows in the market and having their strategy reset. Now, with the company stock, we know that's an issue to click the automatic rebalancing button, because if you are high enough in the company and on the restricted trading list, you could inadvertently sell some of your company stock during a period where there's not an open trading window. So investors with restrictions on trading your company stock, just beware. But for many people, if you don't have somebody advising you on your 401k plan and you don't go look in it that much, I think that automatic rebalance feature is probably a good box to check and to take advantage of markets like we're in right now. Now, Nick, we know that there is one thing that is never a good idea with your 401k. And what is that?
That would be what we in the industry refer to as the big mistake, which would be rashly deciding, it's too painful. The market's down 20%. I can't take it anymore. I'm selling everything. I'm going to cash. I'm going to wait till this thing blows over. And that's just a mistake that can really have lasting impacts to your future, financial prospects. Partly because there's potentially going to be gains that you're going to miss out on. Partly because it can be really scary to decide when to get back in, especially if the market takes off before you decide to get back in. So the big mistake is something that we generally want to avoid at all costs. And I do want to take a second and acknowledge that that's such a reasonable response, because that tends to work so well in every other facet of our life. If you're driving on the highway and you see someone erratically driving in front of you and get that uh-oh feeling, it's best if you remove yourself from that situation and get away from that vehicle. If you're having an altercation with someone in your family or a coworker, it's best to go ahead and have that conversation up front and be proactive and not let something fester. It's really only in the markets where inaction tends to be the best thing possible. I'd almost compare it to if you're at a professional baseball game and it's at the end of the game and it's tight and your team's pitching and the bases are loaded, it would be the equivalent of saying, give me the ball, let me go pitch to the professional batters on the other side. And it's almost just kind of taking that humility and realizing, it is scary, but the best thing for me to do in that situation is to stay in my seat and just cheer for the outcome that I want.
And I've also found over the years, Nick, that when people have enough cash in the bank, they've got their rainy day fund in really good shape, it really helps people to weather the emotions of the ups and downs in the market. If you are making that rash decision to go all the cash because you're fearful about the future, well, part of that fear may come that because you're not comfortable with the other areas of your financial life. So I think another good thing investors can do if they're worried about a recession or you're worried that your job may be in jeopardy if there's a downsizing at your company due to recession, just have enough cash in the bank. Now's the time to make sure that you've got that piece of your financial plan buttoned up. So as we wrap up today, Nick, is there anything else that investors should be doing now in anticipation that a recession may be coming if it's not already here?
It's interesting. I think it's something you actually just touched on, Lisa, is that even without maybe realizing it, I think what a lot of investors do is you see a recession coming or you're scared of the market falling off for any reason. And there's this voice in the back of your head that says, oh my gosh, if my portfolio experiences this drawdown, am I still going to be able to retire when I want, or pay for my kids' college when it's coming up in a couple of years, or take that trip I wanted to? So I honestly think one of the best ways to stay in your seat, if you will, is to have that financial plan outlined before the next bad event comes. Because a lot of people, for that fear, they're probably going to be in a fine situation where their finances are going to be able to handle any kind of choppy water on the horizon and still be able to reach their goals. But it's a lot more frightening when you don't truly know where you stand. So by being able to work with an advisor, have a plan set up, it gives you a lot of helpful context in that, bad things may happen on the horizon, and in the markets, they probably will happen several times over the course of your life. But that's okay, because I know where I stand relative to where I want to be in the future. And my current portfolio setup will more than allow for me to still reach my goals as we progress towards that end destination.
That's so wise, Nick. Thank you. And thank you for joining us today to share your wisdom and insights on investing your 401k before, during, and after a recession. If you would like to speak with Nick Fazio, give him a call at 404-760-9000 and follow him on LinkedIn. Thank you again for joining us today, and be well. Stay tuned for an important disclaimer. The statements and opinions expressed herein are subject to change without notice based on market and other conditions. The information provided is for informational purposes only and should not be construed as investment or legal opinion. Please consult a tax or financial advisor with questions about your specific situation. Investors may not invest directly in an unmanaged index. Past performance is not a guarantee of future returns.